Hello and welcome to Leviathan News. I'm your host, Samuel McCullough, and today, this episode is sponsored by Frax. They are a longtime partner of Leviathan News and have been extremely supportive of Leviathan throughout our entire history. And you can find our squid token on Fraxtal on the Curve Pool. We also have a Llama Lind where you can borrow against it as well too. And we also have some LP in FraxSwap. I really love Frax. I've been a supporter for a long time, and I know that a lot of other people in our organization feel the same. So go check out frax.com today to learn more. All right, let's jump into today's news. The biggest news of the day is that there has been another blow up on the size of Terra Luna this weekend. Just incredible numbers. MantraDAO, with a market cap of $6 billion, lost almost 90% of its value in under an hour after one of its largest investors blew up and was forced liquidated on exchanges. And just a wild story. Mantra had risen spectacularly over the previous year, rising almost 400%. I got my numbers wrong here. 400% to a $6 billion fully diluted market cap. But that number doesn't tell the full story. If you take a look at all of the on-chain data of who controlled what, it was apparent that the team plus the core set of investors and a few other actors controlled about 90% of the supply, 91%. So it was very easy to take this low float, high FTV asset and just pump it. And there's a lot of benefits to this. So when a team increases the value of its token, it's able to find lending deals against it. So say I'm a team and I've got $1 billion worth of these tokens. Sure, I can go out and I can find a $50 million loan that's callable in case, the price drops 90% in this case, and pay a nice set of interest for it. It's really a great deal, right? Plus, with low float, you can pump your token into the top 100, stay there for long enough that hopefully you become a blue chip asset that people want to buy and think is really great. And eventually you can just distribute all your tokens out, sell them, and nobody would know the wiser. It gives you like a long runway to figure out what to do and maintain your market cap. For MantraDAO, this all came undone over the weekend. A person who was using OM as collateral on an exchange, supposedly. This is all just hearsay from what I've seen. This comes from an interview that the CEO was giving, or head of MantraDAO, essentially saying that one of their investors was using OM as collateral, had borrowed a lot of capital, and essentially just got liquidated. He got margin called. And at that point, his size of position was so large relative to the float of the asset that itself, that it put a lot of significant downward pressure on the token price. And the market makers who are providing liquidity at these levels essentially have to decide, are we going to be exit liquidity here as these liquidations take place? Do we want to be the people holding this asset? Do we want to put these OM tokens on our books? Or do we just want to stop offering? Let the bids drop. In this case, the latter is what happened. Market makers dropped out. Nobody wanted to bid. And the price just kept falling and falling, eventually coming down 90% to where it settled as of right now. Just incredible value destruction across the board. What's wild is that I think that if you had followed level-headed and honest people in crypto Twitter, you probably never would have invested into this. many people who I respect on crypto Twitter had I'd seen public comments that they'd made specifically about MantraDAO and the shenanigans that they were running. And I just had a bad feeling about it. I didn't know that it was going to crash 90% like this, but I don't think anybody did. It's a shock. It's on the same level as Terra Luna, in fact. But because the size of the float was so small, many investors were just not in this. I think that the ramifications of this blow up will be very limited relative to what happened with Terra. And Terra went to zero pretty much. These guys still have a $500 million market cap, and I'm sure that maybe in the future they can pull out again if they can find product market fit and they have a good deal. But I think it'll be harder for them to pump the token after this point. Terra made a much bigger splash because it was so interconnected to everything DeFi. People just accepted UST as pegged to the dollar, and they also believed that the 20% yields that was coming from Anchor at the time would just last forever. Or it could be tapered down in a moderate way where eventually the yields would just be fine and people would stay in the asset. That never happened though. Zach XBT came out and named 2 people who you can find in our newsletter that potentially were responsible for this. His story is that they had taken significant amounts of loans against their own collateral that they had, and then had pledged it as collateral inside a centralized exchange, and eventually were liquidated. I'm sure that we'll know more as time goes on, who was responsible for this. Weirdly, the MantraDAO people were saying that there might be some sort of criminal or civil liability in all of this. I don't understand how, but my big question coming out of this for the MantraDAOs is, like, what did they know? Did they have an implicit guarantee that this type of collateral usage was okay? Who else knew about this? Because if Zach could find this out in a day, somebody else has to know more deeply this situation. And it probably warrants a significant amount of reporting to go into this. And if this is really a symptom of things to come, there are many other projects out there like Mantra with low float, high FTV, team controlled tokens that are inflating their asset values so that they can conduct long-term asset sales of their tokens and pocket the cash at extreme valuations, or just are manipulating the market in a way which is beneficial for them, the team, the investors, everyone. And I'm sure they'll get called out as well too. The other really interesting story that I had today in the newsletter, which you should go sign up for right now, if you're listening to this, you probably have signed up already, is that lending on crypto using CeFi sources. So this used to be BlockFi, Celsius, and Genesis, has never recovered after they all blew up back in 2022. The CeFi lending has just been flat, and DeFi lending has overtaken it wildly. DeFi lending represents more than 50% of the total lending market share at this time. Incredible numbers. So congratulations to Aave, and Curve, and Frax, and Dolomite, and Silo, and everybody that's been working really hard to provide these market services for lending. You guys are doing a great job. So congratulations. Love to see it. DeFi will eventually win in the end because it's all transparent. We know exactly what's happening on chain. And as the risks are much more laid out than whatever the CeFi idiots were doing at the time, notably Celsius or BlockFi with all the rehypothecation and just exposure where they didn't even know they had it. just bad juju at the time. That's going to wrap it up for today. Appreciate you guys being here for yet another episode of Echoes from the Deep. We will be back tomorrow. I got a really nice write-up about one of my favorite projects on Fractal that's moving to Sonic, and we'll talk about that tomorrow. So thanks everybody for tuning in, and we will see you at the next tide.